Is the stock market's pain finally over, or is this a bear rally trap? Keep watching to find out. Guys, as usual, none of what we say should be taken as financial advice. What we speak of is purely educational. Now guys, if you're really interested in building a 6 to 7 figure portfolio, we've got the perfect solution for you. Head over in the comment section or the description to sign up for our free masterclass where you can get all these proven steps to achieve it.
Okay, so the market rally.
Yes, in 2023, yes.
Yes, correct. I believe this was like 5 days ago only. Yeah, the market went crazy when the I think the inflation was quite intact, like within expectation. And then China also is like reopening up. And then there's quite a number of positive things. Also earnings also. That one also kind of contributed the rally. Yep. But we will see the bad side first of the thing. But we need to know where this rally, is it a bull or is it a bear rally?
Yes.
So if you don't know what's a bear rally, it's like a fake pump. Just to put it that way. You see like a slowly trickling up, but then after a few months or even a few weeks, the market starts to tank again. Yeah. And then it goes even deeper.
Yes.
Yeah. So that is basically what is a bear rally. And why I actually point out this bear rally is because there's this tweet by Michael Burry. Yep. Yeah, so he actually shared this chart is in the 2001.
Right.
Basically, that is during the .com era. There's a point where the market actually rallied also.
Yep.
But then it tanked even further. So yeah, so he's trying to say that is this some sort like a similarity that's going to happen again this year. But yeah, so this is an interesting chart to compare between the rallies today versus .com era. Yeah. Anything you want to add for this?
No, it's very true because you have to understand time frames. And for a full-blown bear market, it can take 18 months to 24 or 2 years, right? I mean, on average, some are longer and some are shorter. So but you see, in between that, there might be certain spikes, which is what we call bear rally.
Yep, correct. Okay, so here are some of the bad signs first. I believe if you just look at any of the news globally, people are actually hiring quite slowly. They don't really like simply hire as opposed to in 2020, 2021.
Yep.
There's also, can see the tech layoffs in 2022. This is the companies and the number of layoffs that they actually currently is doing. And then basically there's all sort of like unemployment issue put it that way Yeah. And speaking of employment, right, there's this chart which actually shows you the time where there's more full-timer versus part-timer during a recession or market crash. So in the 2001, this is the tech bubble. So if you notice, right, this trend of this part-timer, which is the red line, is actually going up a little bit, whereas the blue color line, the full-timer, is actually going down. And that happens during a market crash. So this is the .com era. It's pretty interesting. And then in 2008, that was a global financial crisis. So you can see again, part-timers going up, full-timers going down. And then in COVID, also somewhat, I mean, this one is like a massive drop.
Of course.
But then it slowly like trickle up. And then, so this one, the chart doesn't really tell much. Maybe it does, this small little one. So it goes down, then this one go up. And then we're going to see another repeat of history again. So if you notice, the part-timers is slowly trickling up and then full-timers is dropping.
And so just to summarize, it means that as part-timers start to become a bigger share of employment, it means that a recession is either here or coming.
Yes, correct.
Right. So I think that makes sense from a business perspective, right? You know, companies are willing to give full-time employment when they can see that their business there's a lot more clarity, right? I mean, from a business owner's perspective, cost is very important. So sometimes, especially when things are good, especially for tech in 2020 and 2021, what you will see is that, you know, people have more positivity, more optimism. So as a result, they get more full-time stuff.
Right. So yeah, this is basically just an interesting chart that I wanted to show you guys when I was like researching about this. And the last few points we have here is war. I mean, it has not stopped yet. I mean, it's still been ongoing. And this is the latest news is that Russia just threw down like a nuclear gauntlet to Kyiv, which is in Ukraine. So so far the signs is still not really clear when is it gonna like end or whatnot. But
and I think with like employment, for example, it's both a leading and a lagging indicator in many ways. So what you have to do is to see the breakdown between hirings and firings. Of course, we look at the net effect, but sometimes you can see companies firing and hiring a lot at the same time. And if a company is aggressively hiring, that is a leading indicator for the future.
Yep.
But if a company is laying people off, there's a good chance that it's lagging in response to maybe something that's already happened that they think is negative. So by and large, employment is usually not the key factor to look at. The most important is always the business fundamentals, right? Why are all these companies in, let's say, semiconductors or tech starting to lay people off is because they are in the down cycle right now. So it's better as an investor to figure that out rather than employment as much. It's still important to get a sense, but I always believe that once things start to, like the tech layoff is something that a lot of people know about already. It means that it's information that's not going to be very useful for you because it has
it's already
happened.
there. Yeah, it's already happened.
Correct.
Right. So it's a lagging indicator.
So you have to see, like, from today, based on what's happening, what is it going to look like in 6 months, in 12 months?
And I believe you actually mentioned this a lot in the big picture report in FIRL Pro.
Correct.
So if you are interested to check out FIRL Pro, make sure just to go to our website, learn.firl.co/courses/FIRL Pro.
Yes.
Okay, and the last thing that I want to show here, which is actually pretty interesting, is because the household savings is actually deteriorating. And they actually predicted, they is JP Morgan again. JP Morgan, right? The guy that actually famously wrote a very bad report on glove. So it's them again. And and they did a bold claim. Basically, they're going to say that the housing savings is going to be gone in mid-2023. So this is where I disagree. I can agree that it's shrinking, but when you say it's gone, I'm like, excess. I mean, they put excess savings.
Okay.
So those are the few charts that is the bad sign. And in the next segment, we're going to be talking about the good sign of the market.
But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description. Okay, so now how about what's good, right? When it comes to markets, always look at both sides. Don't anchor yourself to a single narrative. Always look at both and decide from there which camp you want to have a bit more of your money in.
Right. Okay.
So this is Michael Burry, okay?
Yes, him again. So I believe this tweet was in 2022, June 30. He basically mentioned a lot of things, blah, blah, blah. But the key thing that he mentioned over here, the final, his bare remark is basically there will be earnings compression. So thankfully, a lot of companies actually reported beats in earnings. So you can notice like Tesla's actually report revenue and earnings beat, which actually resulted their share price to actually went up after they have bottomed. Not only Tesla, also Visa and Mastercard also beat earnings, which tells you a lot about, there's a lot of revenge spending in terms of traveling and then cross borders.
But see, that's the interesting bit, right? That is what you're seeing, the earnings now is what happened months ago. So again, echoing my earlier point, you have to be careful. You have to figure out what's happening right now and in the future as well.
Correct.
So that's the one thing you have to take note of.
But just to summarize, right, the Q4 2022's earnings data, you can see that almost like 90% of the companies that's reporting is in they are beating earnings, which is actually pretty good. And then finally, the reason why I put Netflix over here is because they actually miss earnings. Yeah, but they still rallied nevertheless. Yeah, so that's a pretty interesting bit. Okay, so now we know the bad and good sign. So now we want to dictate whether this is really a bear rally or is it a bull rally. For me, I'm still pretty uncertain.
Yeah.
But what do you think, MJ?
I think if I had to bet, right, it's not going to be as good in 6 to 12 months time compared to today. Just as I foresaw in 2022, the same thing. Will the decline in 2023, in my view, be more pronounced or less pronounced than 2022? I'm not sure. But I do know in the service sector for the US especially, it's really not looking good. It's still growing, but then the growth has shrunk by a huge magnitude.
Right.
So perhaps that's why they are laying people off in terms of tech. And so it could be that market might be overreacting to the earnings beat. It could be. That said, it's important to realize that it's still possible to make money in a bear market. So example would be our FIRL Pro, right? It's up 19%, something like that. In a period where markets have generally been down, right, in 2022. Now, why am I sharing with that? It's not to flex or anything, but it's just to share with you guys that at the end of the day, if you construct your portfolio properly, you can actually do what we call a low correlation with the market. What does it mean? Well, you want to structure your portfolio in a way where it doesn't get too much affected by news of tech layoff or whether the S&P or Nasdaq is up or down, the KLCI and all that. Why we have done so much better than the KLCI so far in the past 6 months is because we focus specific to that industry or that company. What are the driving factors? Because, for example, one company that we looked at recently was a metal extrusion company, Kinhe, right? It's one company that we cover in our FIRL Pro program.
Yeah. Leak.
Yes. And you think a company that does metal extrusion has any relevance to tech layoffs?
Yeah.
Even to interest rates?
Yeah.
It really doesn't, right? And so this is what I mean by it's insulated by all these kind of big waves and big news. And that you're primarily focused as an investor to make sure that the industry that these guys in, the position of this company in that industry is pretty decent. Doesn't have to be great, but just decent. And if you buy it undervalued with a margin of safety, that's how you can weather through, and that's how you can make money in a bear market. Whether it's going to be a bear rally, whether it's going to go down again, if your portfolio is filled up with all these uncorrelated positions.
Yeah. Okay. Speaking of undervalued, right? These are the two strategies that we feel that you can implement. So this is by Sun Tzu, never go full art. Sorry, wrong one. You have to believe in yourself whether is this a bear rally or not. And these are the two strategies that you can execute. So the first one is basically valuable business, which is what you mentioned just now about undervalued. So this is again by Michael Berry. Basically just looking at companies that have a low price to cash flow business. Basically why they are actually much more attractive is because they have more capital to buy back stocks, to buy back debt at a discount, and also to manage their capital structure better. So that is basically
so really what he's saying here is that typically in the last time you can reinvest into your business and you can get good growth. Mostly because growth is quite easy to get because of interest rates, right? But now with interest rates being a lot higher, you want to go for what Warren Buffett called the 1 foot hurdles or bars, jumping over 1 foot hurdles. And, buying back stock is exactly that. Now, a lot of people don't like stock buybacks because it's quote unquote financial engineering. You reduce the pie, but then your share of the pie increases. And so that's how you create more money. A lot of people during the past 10, 15 years prefer to put it back into the business to grow, to build more factories, to spend more in equipment, to hire people and all that. And there's nothing wrong, but you have to understand that not every company has that profile. It would be wrong to buy back stock if the company requires more reinvestment into the business. But if it doesn't, and you are free cash flow generative, buying back stock is not a bad idea until you find something else that you can reinvest in.
Yeah, i.e. the earlier example is Top Glove.
Yeah.
When they're buying back stocks when they need to deploy.
Yeah, but Top Glove doing that in 2021?
Yeah.
When the stock was at a high.
Yeah.
So today, that's why you look at what Michael Burry said right at the beginning, low price to cash flow businesses. But Top Glove wasn't low price to cash flow in 2021. Right? So that's one interesting thing, right? Because when you compare it to 2000s, when the crash came, so did the interest rate drop in tandem. But today, it is the interest rates going up that is causing market disruption. So at the end, he says that, math problems that more or less must work out, which I would agree.
Yep, correct.
So again, long to short, you should be finding quote unquote low price to cash flow businesses, especially if they are buying back stock. If you're a US investor, in Malaysia, that's not in the culture.
Yeah, correct.
Because typically also all these management have already a lot of stake in the company. So maybe just look for low price to cash flow ratios. And most of our stock in FIRL Pro is actually like that.
Yep, exactly. Which is also tells you the returns. We're going to be disclosing our returns later for the January 2023. But the second strategy that we have here is basically just going crash. So this is an interesting fund manager.
Yep.
This is TradeView Capital.
Yes, friend of ours.
Yes, correct. If you notice, most of the institution investor or even fund manager like your Affin, your Waybank or whatsoever, they are actually fully invested.
Yep.
And they only keep like 20 to 30% cash. But this fund manager in particular, which is TradeView, they actually kept about 85.5% cash. So yeah, this is actually another strategy if you don't know where the market is heading, right? It's always safe to actually keep cash. I mean, then you may say that, wow, wouldn't inflation eat up the value of cash? Well, it will eat up the value of cash if you are actually spending on things that actually went up in value. Yeah. And
but also in TradeView's case, they also just started a fund. So they're inching into the market.
Right.
So I think the fund is like a month or two old.
Yep, correct.
So they've only allocated 15%, which is quite fast actually. So about 40.5%. Into the market.
Yep. So that's about it for today. But before you go, just to disclose to you our stock performance for January 2023. One of the stock is almost going up 2x already in just a span of I believe it's 5 only months. It's only like 1 or 2 months only.
Oh, for that stock, yes.
For that particular stock only. But overall, the portfolio has been doing pretty well in a quite a bad market environment at the moment. But if you are interested to find out more about FIRL Pro, how we actually write our reports and also our SIB program, you can check out the free sample. We'll put the links in the description and comments down below. But MJ, is there any final words that you want to add for today?
Guys, again, it's risk-free. Just go check it out. If you don't like it, that's fine. If you like it, glad to see you in the program. And guys, thanks for staying all the way until the end. I'll see you in the next video.